Right, let's get started. What we're looking at here is TLT. These are 20-year US bonds, US open market debt. So the importance of this is if you get a dysfunctional bond market, then that creates all sorts of problems for everything from the whole fiscal situation. Because if your debt gets more and more expensive, and the lower the price of these bonds, the higher the interest rate on the bonds, then this chips away at your balance sheet and ultimately affects what you can do as a government, and it has ripples through to the commercial sector as well. So today we've got a bounce in the bonds. We've got ECB meeting on, is it Thursday this week, I think? A lot of data. We've got US jobs, UK jobs tomorrow, US GDP this week, and so on. So the reason why I'm showing you this is because this is why the markets have been dropping, certainly last year and this year. You can see if we go back further, you can see as we got going in 2022, last year, the yield increased as the price dropped. There's a divergent relationship with yield and the price. And the same thing happened today. The yield has increased as the bond market has dropped off. Basically, what this means is the bond market is getting ditched, it's getting sold into, and so the cost of borrowing is going up with all the impact that has on running a country, running a business, whatever it is. Okay, so if we now look, I want to show you another interesting chart before we actually look at some markets here. Well, let's look at the dollar. So you can see as the bond, so this has been behaving like a safe haven. So once we got into the summer of this year, so the markets performed well into July, and then once the dollar got bought, then we've seen all this, some significant selling in the equity markets and of course the indices. So if today this dollar's dropped off and the indices have picked up, divergent relationship. So this is a normal, healthy relationship. But the issue comes from if this safe haven gets bought on the support here, and the bond market continues, I mean, if the bond market really takes a dive here, then interest rates are going to have to continue to go up to prop them up. And of course, the higher the interest rates, the more damage it does to the consumer, to the whole balance of the economy. So that's why I'm showing you this, to explain why these markets have been dropping, but we've come into some support now. So they've got a lot of good technical support here as we head in towards US GDP. So this is this 50% of this range, of the 22 range, has been so far been bought, as it was in the beginning of October. So if we come out of the end of this month holding up, or end of this week, more importantly, and we've got Fed next week, we've got Bank of England, ECB this week, Fed and Bank of England interest rate decisions next week. So the market obviously wants interest rates to be put on hold further, but potentially into next year. I don't think that's possible because inflation is stubbornly high, and the Fed chair continually repeats the mantra that the economy needs to slow to manage inflation, and only then will interest rates come down. So that's why we still need to be on our guard for lower prices in these indices. And in fact, today we've seen quite a big hit on the oil. So oil is normally very divergent with dollar. So dollar's dropped off, which you would normally expect oil to pick up, but it's not. It's dropping off. Why is it dropping off? Cyclically, oil tends to drop off this back end of the year anyway, and then pick up in the early part of the year as the contracts get in place for the dry season. So if this continues, but obviously we've got conflict, we've got tension in the Middle East, which has a tendency to drive up the oil price, and it has done into Thursday last week. But now we're falling back into this channel support. So at the moment, it looks like we could come and see 82 and possibly lower if that keeps going. All right. So what am I looking at in terms of investments? Well, gold is the obvious one, and we've already seen a sharp rise in the gold. So it was very, very weak, and so we've got a buy signal down here on the 6th of October, and we gapped up. So we've got this gap opened up and still open to this day as the gold is pulling up. So this has been a tricky trade, because if you missed out on this action down here at 1810 plus, you would have to risk going in higher or stand aside while this thing runs up. So where do we go from here? I would expect, if we see a decent GDP number this week, and the consensus is, let's have a look at the consensus. Let's look at GDP. Oh, this is not showing us consensus. Let me get another chart. Hang on. We've got CAD rates this week as well. Yeah, ECB 1:15 London time on Thursday, and the consensus for GDP on the US on Thursday. So you can see there's a lot of data this week. So here we are, GDP 1:30 London time on Thursday. We're looking for 4.3%. And there's the stats for this year. So bounce back in 2020, higher numbers in early 21, drop off in 22, and trying to see some sustainability in 23. So if we see a decent GDP number, who knows, we might even fill the gap, because a strong GDP could mean a bounce in that dollar. All right, so this is tricky. This is a tough call. All the time sitting up here, there is, well, you either bought high or you just missed out, unless you're lucky enough to get in a hold on that Friday. So we saw a pullback on the Monday the 9th, but only into 1845, which was nowhere near a gap fill, which I was waiting for. And here we are at 1975 already. Okay, so in terms, as far as gold is concerned, I think the best opportunity in gold is going to be for a high GDP number, and for this to really get yanked back as the dollar pings up in that scenario. If this stays at this high level, your options are limited. But so I'm crossing my fingers that we're going to see a significant drop, potentially all the way back down to this at least 1870, which is where we saw this huge bounce on the 13th of October. So normally, if you get a big bounce where a lot of traders miss out, you would see that retested. And of course, a gift from the trading gods will be 1830 to close that gap. But it is very hard to see that, given that this is pinged up so high. So that's why I'm at the moment only holding out for a drop under 1900. Okay, so let's just go through. I'll answer the question about what would I invest in right now. I would stay out of oil. I did buy oil early today, as we had so much support intra-week. But obviously this is a lower close, so I'm backing off. As I was talking about a big punch up in the price of gold, well, oil had a big punch up at 82.50. So at this stage, I would put a big line in the book under 1850. And again, you might see that into all the data on Thursday. So, you know what, with so much data coming out, and Thursday being so important with ECB rates and US GDP, it is possible the oil could drift lower this week. And then if we do hold a 250, then buy that. Of course, with the geopolitical situation at the moment, this could pop up any minute. But that is not obviously a tradable attitude towards trading oil. I would very much hope that we can come and sit back at least in 84, if not lower. All right, so now I've seen oil pull back and potentially close lower under these averages. I'm waiting for a much deeper pullback now, having been stopped out of a day trade. Let's look at the euro. Let's carry on the theme of what the dollar's doing and the impact on the markets. The other thing that, just coming back to the bonds a second, one of the most critical factors in the instability in the bond market and the higher yields that we're seeing in these bond markets is it restricts the flow of money, the velocity of money. And if you've got it's pretty obvious for all of us who've been trading for months, years, and whatever, decades, that if you've got a lower velocity of money, then that affects the consumer. Consumer will rein in, and you can have the obvious problems of a consumer reining in. So that's why September, October are normally pretty volatile anyway. So that's why the outcome of this week is going to determine whether we see the traditional rally into the back end of the year. And already we've seen, so if we can hold these levels in this Dow and pick up, then that could project us back into these summer highs, at least the summer highs, potentially even a retest of this year's highs, if we come out of this week holding this support. So close underneath 32,800 on this Dow, and we're going to fall right back to the March support. Okay, let's have a look at the FTSE. So the FTSE rejected the 7,700. So a significant few days of selling. We're just consolidating here in this support, but if we are very bullish in the FTSE, sorry, bearish in the FTSE, I meant to say, sorry. If we're bearish in the FTSE, we've now got potentially got a crossover here. Consolidations are over. At the moment, we are just waving in this box, and the box is getting tighter. This area here, so we saw a lower high as this came down into this support. So if the highs are going to continue, so we've seen all these highs and lower highs sold into, and we've got lower lows here. So this consolidation is going to be potentially finished as we come and meet some of these averages. So if this FTSE pings up into 7,500, 7,550, that's where I would look to sell on the next leg to get the leg down potentially into 7,200 and ultimately down to 7,000. I'm going to be wrong if we close above this. If we at some stage in the next few days, and obviously the back end of the week, start closing above 7,500, then we could ping up and go and see 8,000. But my money at the moment is being patient and waiting for 7,550 to see if we can get this down leg to ping back, to retrace, and then find the next direction. So let me just clear this up. So I'm looking for this to ping back. So you've got a directional move here, ping back into these averages, and then leg down further into 7,200 and 7,000. The longer term, just got to bear in mind we've got UK has got elections next year, and the US has got elections as well. And typically, let's see, election years, I can't remember the average now, but there's a very high percentage of election years where the markets actually hold up. I'll talk about that another time. Let's just focus on the immediate days and weeks now. So let's have a look at silver and look at a few commodities and look at a few stocks. So silver had this nice move. So we saw all this series of lower highs here in the silver and lower lows here. So at the moment, all the silver's done is, bear in mind that silver is much, much more commercial than gold. So if we're bearish on the consumer and indices, then it stands to reason that the silver may not hold up here. However, if we come down, now silver did actually close the gap. It did actually gap up, but closed it, unlike gold. If we pull back into this support and hold 2021, then I'd be very much a buyer. I would love to get the opportunities to trade silver, because I'm just a huge fan of commodities, full stop. I still believe, as I keep repeating, I still believe we are in a commodity super cycle, which is one of the reasons, which is potentially detrimental to the markets in a wider scope. So because of inflation. So if we are still in the commodities super cycle and these dips get bought, then ultimately rates are going to have to stay high to try and offset higher prices. So the corn this is not a great chart. However, we have broken up through this trend line and we're pulling back into this support. So if 490 holds, I will be happily buy corn to see if we can get back to 550 plus. I will keep you updated on that, because again, as we get in the back end of the year and getting to the planting season, this could get juicy. The wheat has been a tough one because it looked as if it was going to hold this support down here and then pinged underneath it. So we ended up with head and shoulders. if anybody was at the previous commentary on the wheat, you would hear me talk about how commodities do tend to break support and then ping back. So if we ping back into this trend line support down here at 550, 560, I think the wheat, if the wheat retreats back into that breakup area, I would love to get involved in the wheat again. Because if you let's look at the weekly on this wheat. Let's just hover on the wheat a bit longer. Look at this weekly chart on the wheat. You can see we've had, ever since we had this drop on in late September, we have been closing higher. So any pullback into that 590, if that holds, we could ping up to $8 and more very easily. Okay, let's look at natural gas. So natural gas is pinged up. So we've now got the floor in natural gas is about 30.50. I still think there's plenty of time to get into this. However, typically, traditionally, the natural gas would peak into November. So if we pull back into 30.50 and hold, I think 54 is a possibility to back up into this October resistance from last year. So I'm liking, it's a good cyclical trade. I think natural gas is a good cyclical trade. Let's look at copper. Copper is, some people talk about copper in terms of being the new oil for obvious reasons, because electrical vehicles. So this is a fantastic support here in the copper. We've seen some volume in here. This is a weekly chart. Let's go back to the daily before I forget I'm on a weekly. Yeah, so if we hold this copper price here, I think the copper stands a very good chance of picking up. Got a lot of overhang in the copper. But picture this, if we start closing above this 80.81, then the copper could ping back up to 90 plus. So the volume that's coming in and the price action that we're seeing in the copper bodes well. Right, stocks. So my take on the markets as we stand at the moment is I'm just relying on commodity related stocks. This is Man Group. So last Friday we saw 210. Here we've seen this come into 218. So 215 in Man Group on the London exchange, on the London market, is now buyable. And if we find ourselves above 233, then that could take off as well. If I look at Gem Diamonds, nope, don't like it. Stocks like Glencore are pulling back into support. So don't be frightened off by this one, because this one, so there's no reason to buy this one at the moment. Could potentially come and see £4.10 on Glencore, at which point I would buy that one. Rio, same chart pattern. So be patient, keep these on your watch list and see what happens the middle back end of this week. Other ways of playing, these are good ways of playing these commodities, which is why I like them so much. TPI cap, this is already getting going. So back in the summer, we saw 136. This is 170 already. I still think this is, so I think 165, 160, 165 is decent support. You know what? If you're patient, you might see that this week, because if we see that and they ultimately close above 173, I can see this going back to £2 plus. All right, so I just love the commodity and commodity related stocks. And the flip side of this is, let's look at the banks. They're hit. So what I've been telling you about in the bond market obviously applies to the UK as well. And Barclays is looking like that could come and see 140 at least, if not lower. Legal and General is falling back. That looks lower at the moment, although we did see a reasonable bit of volume coming. So let's look at health. Let's look at miners, and then anything you want me to look at, shout now. So I'm going to talk about this one. Well, I've talked about this one for a couple of years, at least, off and on. I'm in this. So we saw a nice price down there at 13. We've recently seen 16, 16 and a half. This is still buyable at 15. And if I'm right, we should go and find 20 plus on Pan-African. Hochschild. That's already underway. Volumes are not bad on Hochschild. Griffin. No, the Griffin's horrible. Stay away from it. Centamin. Ooh, that's not behaving at all well. I think Centamin's got exposure to Egypt from memory. So that's close to the conflict. So that could be the reason why that one's falling back. Right, okay, but if I cross into a couple of, if I look at housing stocks, weak, Persimmon, you can see the volume, the price of these stocks is very weak, and they are just selling, not holding up. All right, so that's why my attitude towards investing and trading as we head towards the back end of this year is in line with commodity related stocks, energy and commodity related stocks, and staying away from the consumer, anything consumer related, including housing, not just the retailers and so on. Any questions? I can see the market's taking a little bit of a hit. The oil is still weak. Okay, no questions coming in. Right, so I've done just under half an hour. I'll leave it there, and I will be updating you on anything relevant as we get more and more data coming through this week. But yeah, be careful with this volatility. We've got a lot of data to get through, and we've even got UK jobs first thing in the morning before London opens. So I think we're seeing a lot of volatility as that unfolds. Right, thank you for joining me, guys, and no questions come in, so I'll leave it there, and I'll update you as the week unfolds. Thanks very much, and bye for now.